Video is going to be on the wheel. Someone in the group, the guy that I did the last video for, who was talking about mitigating risk with a covered call when you don't want to have the shares bought from you and you want to stay in them. I'm trying to tell him I personally don't buy the shares. I sell puts until I'm assigned. Video is going to be on the wheel, the full cycle of a wheel. I sell to enter and I sell to exit, not selling the shares to, right? I sell to enter the shares and I sell puts to enter the shares and I sell calls to exit the shares. Okay. Well, if you're going to sell in this scenario, it's less risk because I'm making more money. Well, if you're going to buy that, you can't use the argument, oh, it's not risk free, right? Well, you were going to buy, we're talking about a scenario where you're already buying the shares. So it is less risky, right? Because you're hedged in a way, to an extent. You're getting paid. So that's somewhat of a hedge, not completely. But let's go into this a little bit. Mara. Let's say we wanted to run the wheel on Mara. Oh, would you look at that? Here's the last Bitcoin halving. What did it do? Mara was trading around 42 cents and it had a high of $75. So you 150x'd your money if you bought it at the low. You wouldn't be able to sell a put. Maybe you could sell a 50-cent put, right? You would have been assigned there, but you're not really making that much. But anyways, I would have just bought the shares flat out right over here. Now it makes sense. 9.95 is what the shares are trading at. How do I sell and get paid to enter and get paid to exit? Okay, I would trade Mara. Okay, I can just simply pick a price that I want to buy Mara at. If I'm wrong, I get paid in the meantime. If I'm right, great, I got paid to enter. And we'll talk about how you sell calls to exit. So I'm selling puts to enter. Okay, not buy, sell, put. I have to sell a put. I have to have the money to cover 100 shares per contract. I sell one contract. How much is a $9? Let's go out here a little bit more so we can get paid a bit heavier. I want to buy Mara, let's just say hypothetically at $9. Okay, sell, put, 9. How much money do I need on my account? 900 to cover the 100 shares that I'm going to have to purchase because I want to purchase this. Okay, hypothetical scenario. Let's say I want it at 9. Now, if it does by December 15th, right here, if it's at $9 or below, even if it's at 5, I am agreeing in this contract to buy it 100 shares at $9 each, no matter what the price is, even if it's a penny. Okay. Now, let's say it drops, it's right at 9. What happens to the options contract? Well, it doesn't matter. In either scenario, if it's not at or below 9, I get the $62. If it doesn't hit 9, I get the $62. I actually get the $62 the second I hit continue here. That's accredited to my account. That's my money. It's over, right? Now, how much my dollar cost average is lower though. I'm not paying $900 for the shares. Let's say hypothetically on December 15th, it's at $9 on the dot. Okay? 900 minus what? Minus 62, because that's how much the put cost. 62. I own the shares at $8.38. How? Well, I got that $62, right? So now let's go ahead and let's write this down. Let's keep track of this. We own them at 8 point, what was it? Hold on, let's do the math again. 900 minus 62 equals 838. 8.38. That's our dollar cost average. Let's say on December 15th, I was assigned the shares at $9. Great. I wanted to buy them anyways. That was the whole point, right? Now I own them for less. Even if it was at 850, I still could sell the shares profitable because my dollar cost average is 838. I can still exit and make money, right? Do whatever you want. I could sell the shares for profit and then resell a $8 strike, right, for a further out expiration. Now let's say I want to hold the shares and run the wheel. Now let's say we are assigned the shares at $9, right? This is the first stage of the wheel. The second stage is this. What if we want to get out? Okay, remember we collected $62 in premium. Let me keep track. I'm going to keep track of this, okay? 62. I should be doing this on a spreadsheet. I'm sorry, guys. This is very cheesy. Now let's say it's December 15th, right? So we'll just assume, we'll move up here. Sell call against the 100 shares that I own. Okay. Well, we don't know what the prices are going to be, what the price of Mara is. This is all hypothetical. I paid $9 for the shares, right? Do I want to sell an $8.50 call? No, because I'd be selling the shares right around the price that a lower price than I entered them for. I always want to sell above anything 9 or above, anything above. Okay. So hypothetically, let's say we're going to sell the $10 calls. All right. Now it is a covered call. I'm going to write one call against the 100 shares because the contract is against 100 shares that I own. Sell call. Now it's a covered call. That easy. I hit continue and I have now entered a covered call. Okay. I'm collecting $124 of premium. So now let's see what the dollar cost average of this is. All right. We are now getting minus $1.24. Now my dollar cost average on the shares is $7.14. Those shares are gonna have to go below $7.14 before I'm operating at a loss. And you can see where I'm going with this. I could sell calls forever till the shares are free. My dollar cost average is negative. Now, let's say hypothetically that Mara hits $10, okay? By whatever the date is, December 22nd. Okay, this is all hypothetical. Well, let's say Mara shoots up to $10.50. Let's say $11. Well, I agreed to sell those if it hits 10 at 10, right? And the person on the other end is going to get assigned those shares at 10, and they'll be buying them from me, hypothetically here, in a way, at $10 a share. I bought them at 9. That's $100 profit. Keep in mind, I also made 62 plus 124 on this call I sold equals $186, right? See this? 62. Remember the put we sold? That's 62. We sold this call at 124 right here. That's a total of 186. Then the shares. Remember, I was assigned at 9. I had to buy them at 9. Someone just bought them for 10. What's that difference? $100. Okay, 186 plus 100. $286 profit. Right? So that is a full cycle wheel. I entered, I sold to enter, and I sold to exit. I sold a put to enter, and I sold a call to exit. Okay? So for those of you that don't understand, everything's opposite on the sell side. And you're going to confuse yourself. Wait, what's the break even? What happens if it hits the break even? I don't understand. Right? You're confusing yourself. You don't need to know that right now. All right? When we buy a call, we want the stock to go up. When we buy a put, we want the stock to go down. Okay? When we sell a call, if it's a covered call, that's different. Right? It depends on what you want to do. If I'm selling a call and I want to keep the shares, I don't want the stock to go up. I want it to remain neutral. I just don't want it to hit that strike if I want to keep the shares. In the previous video, we talked about it. We can roll it up to another strike. But I want to keep this simple. We'll get more advanced in the future here, and we'll go into more hypothetical scenarios. But that is the wheel. Sold to enter, sold a put to enter, and I sold a call to exit, right? And our total profit would be $286. I want to do this on stocks with high IV. Now, if it's just building a portfolio, that's a different story. If I'm not trying to run the wheel, if I want to enter Apple just to own the shares, that's a different story, but I'm going to sell to enter. And maybe if Apple went parabolic on earnings, then I can sell a call way out of the money, betting it's not going to go up higher, right? Another week out. But I'm getting a little off topic here. Just want to do a quick video of what the wheel is and how I utilize it in my um, which is one of my trading strategies, which has been very profitable. If you guys like this content, please make sure to like and follow.